on finance and economics.
Sounds good.
Yeah, using as our source material the Weekly Edge newsletter from Gilt Investments.
All right.
It's always a fun one, that newsletter. Always tackles the serious stuff, but with a bit of humor. So good stuff.
Yeah, that's always a good combination.
Yeah, for sure. I mean, we're dealing with some wild stuff this week. We've got, Trump's tariff troubles, the bond market's maybe getting a little nervous. We've got a record-breaking UK housing market. What's going on with that?
Yeah, there's a lot to unpack there.
So let's imagine you are an investor this week.
Right.
Trying to navigate these choppy waters.
Oh, yeah.
So the first thing that hit was the tariffs. Trump announced a 25% tariff on steel and aluminum imports.
Right.
Even those from allies like Canada and Mexico.
Yeah.
So why is that a big deal?
Well, I mean, tariffs are essentially taxes on imported goods, and they're often used to protect domestic industries, right?
Yeah.
But they can have kind of ripple effects throughout the entire economy. And the markets didn't really seem to react to this tariff announcement, right?
Yeah, that's what I thought was so weird. They barely even reacted.
Yeah. So what do you think? Are investors maybe missing the bigger picture here?
Yeah, I don't know. I feel like they are. Are they not thinking about the long-term impacts or?
Yeah, I think perhaps they are. I mean, some investors might think this is just a short-term tactic, something that's just going to get, resolved really quickly through negotiations.
Right.
Others might be underestimating how other countries are going to react to this, right? Like, for example, if China decides to retaliate with tariffs of their own, that could trigger a trade war.
A trade war, wow.
Which is bad news for, everyone involved.
Yeah.
So I think that's something that they need to keep in mind.
Yeah. Okay, so let's move on from the tariffs for a second.
Sure.
And talk about jobs. The U.S. added fewer jobs than expected in January.
But the unemployment rate stayed low. So what's the problem? Well,
it's interesting because on the surface, it kind of seems okay, right? Like jobs are being added, unemployment is staying low, but it creates this really, really tricky situation for the Federal Reserve, right?
Oh, yeah.
The Fed, for those who might not know, are the folks in charge of keeping the economy on an even keel.
Right.
And their main job is to control inflation and promote economic growth. But right now, those two goals are kind of at odds with each other, right? If they raise interest rates too much to, try to combat inflation, they risk slowing down economic growth.
Yeah.
Maybe even triggering a recession.
Uh-oh.
But if they keep rates low, inflation could keep chugging along, making everything more expensive. So they're really in a tough spot.
They are. It's a tough spot. And it's interesting, too. The newsletter points out that money markets are predicting that the Fed won't cut rates until July.
Oh.
Meaning that borrowing's going to stay expensive for a while.
Right. And this obviously has implications for, how you invest.
Exactly, yeah.
Right.
And it makes bonds really interesting right now.
Okay.
You see, when interest rates are expected to rise like this, the value of existing bonds tends to go down.
Right, yeah.
Right. And that's because, investors can buy new bonds with higher yields, making the old bonds less attractive.
Yeah.
So yeah, bonds are kind of in this weird spot right now.
Okay. So the newsletter also mentions something called break-even rates.
Right.
Which, I'll be honest, sounds a little intimidating.
Yeah.
What are they?
So, they're actually not as complex as they sound. Think of break-even rates as the market's prediction for future inflation.
Okay.
So basically, they tell us what investors expect inflation to be in the future.
Gotcha.
And right now, the picture isn't, super rosy. Short-term break-even rates, which, reflect inflation expectations over the next couple of years, are rising faster than long-term rates. What does that tell us? It suggests that traders are a little bit nervous about inflation heating up in the near future. And that makes sense, right? Given what we talked about, the potential impact of tariffs, the Fed's kind of cautious approach to raising rates, it's like the market is saying, hold on tight, things could get a little bumpy.
Oh, okay.
So yeah, break-even rates are definitely something to watch.
So should we be preparing for high inflation? Should I be stocking up on toilet paper?
Well, probably not toilet paper.
Like it's 2020 again?
Yeah, no, we don't need to go that far.
Okay.
It's too early to say for sure whether we're headed for a period of high inflation, but it is something to keep an eye on, especially when you're making, investment decisions. Because remember, inflation can erode the value of your savings over time.
Yeah.
So you want to make sure your investments are kind of keeping pace.
Yeah, right. Stay ahead of the curve.
Yeah.
Okay, so we've got tariffs. We've got this puzzle that the Fed has to figure out. We've got the bond market, maybe flashing some warning signs, but wait, there's more.
Of course.
The housing market seems to be, like, completely detached from all this drama. The newsletter paints two totally different pictures here. One, U.S. mortgage rates are falling.
Oh.
Which, on the surface sounds like good news for buyers.
Yeah.
Except
house prices are still going up.
Yeah.
Especially in the UK. I mean, they're seeing record-breaking highs right now.
Yeah, like, what is going on over there?
It's crazy.
It's so weird. It's like the UK housing market is playing like a different game. You'd think that with all this economic uncertainty going around, people would be, like, hesitant to jump into such a major purchase.
Yeah, you'd think so.
But apparently that's not the case.
No. It's really interesting. I think there are a few factors at play here. There's a potential shortage of housing supply. Low interest rates are still kind of, incentivizing people. And maybe even a bit of, like, speculative fervor, right? Like, oh, I need to get in now before it goes even higher.
Yeah.
So, yeah, the housing market is definitely something we need to keep an eye on.
Yeah, we will definitely be keeping an eye on that. Yeah, it's like everyone's trying to figure out, like, where's the safe haven?
Right.
In all this economic craziness,
yeah.
Right? So, speaking of finding a safe haven, the newsletter also shines a spotlight on two companies this week. And it seems like they had very different experiences.
They did.
So Macquarie Group
Yeah.
and Deutsche Bank.
Right.
So let's start with Macquarie. They're an Australian financial services giant, and they had kind of like a mixed bag this week.
Yeah, a little bit of a mixed bag.
Their commodities trading arm not doing so well, but
Right.
their asset management unit actually performed pretty well.
It did.
Leading to kind of flat profits overall.
Yeah, they kind of balanced each other out, right?
Yeah, they weathered the storm. I guess so. What was behind the success of the asset management unit?
Well, it seems like their focus on alternative investments, things like infrastructure and real estate, really kind of paid off for them.
Okay.
These types of assets tend to be less correlated with traditional stocks and bonds,
Right.
meaning they don't always move in the same direction, which is a good thing.
Yeah.
So it gives them a bit of a buffer during, times of market volatility.
Yeah. So diversification, key takeaway.
Always.
Don't put all your eggs in one basket, they always say.
Exactly.
Okay, so Macquarie managed to kind of stay afloat, but Deutsche Bank,
Oh, yeah.
they seem to be in a bit of hot water again.
Yeah, unfortunately, yeah.
So they got fined for, get this, selling complex derivatives
Okay.
to clients who apparently, like, didn't understand them.
Right?
Talk about a blast from the past, right? Giving me 2008 vibes.
Yeah.
Those derivatives.
Those derivatives.
Like, did we not learn anything?
Yeah, well, you know what happens?
It seems like complexity without clarity is a recipe for disaster.
It often can be, yeah. I mean, this situation really underscores how important transparency and ethical practices are
Yeah.
in the financial industry.
Totally.
Clients need to understand the risks they're taking,
Yeah.
and institutions need to be responsible
Yeah.
and not sell products that are, way too complicated
You're right.
or risky for their clients.
It's all about trust.
Exactly, yeah.
Right.
Yeah.
People have to trust the system.
They do.
And when these things happen, it really
It erodes them.
erodes that trust.
Yeah, absolutely.
So, okay, we've got the tariffs, we've got the Fed and their little puzzle.
Yeah.
We've got the bond market, maybe
Right.
giving us some signs.
Little murmurs.
Yeah, murmurs.
Yeah.
This crazy housing market and these like mixed signals from the corporate world.
That's a
What is an investor to do?
I know, right?
Yeah. So thankfully, Gilt Investments offers us some guidance here in their newsletter, and they're really focusing on fixed income.
Yes, fixed income bonds.
Bonds. Okay, so they're saying that's kind of the safe haven.
Yeah, I mean, they're known for their expertise in fixed income.
Okay.
And their recommendations this week definitely reflect a more cautious approach, which, given the current climate,
Makes sense.
yeah, it makes sense.
But, okay, hold on. Earlier you said that rising interest rates can actually hurt bond values.
Right.
So how do we reconcile those two things?
So that's a really great question, and it's all about, understanding the nuances of the bond market.
Okay.
Yes, rising interest rates can lead to lower bond prices,
Okay.
but there are ways to kind of mitigate that risk,
Okay.
and that's where Gilt's recommendations come in.
Okay. Tell me more.
All right, so their first suggestion is to focus on short-term bonds and floating rate notes, or FRNs.
Okay, so short-term bonds, I get that. Those are the ones that mature pretty quickly. But what's an FRN?
So FRNs are kind of a special type of bond where the interest rate adjusts periodically based on a benchmark rate like LIBOR.
Oh.
So as interest rates rise, the interest payments on your FRNs also rise, which helps to protect your investment from the negative impacts.
So it's like a little buffer.
Yeah, exactly. Like a built-in hedge against rising rates.
Okay, clever.
So, yeah.
What else?
So, given the concerns about inflation, they also suggest looking at inflation-protected bonds.
Okay.
Specifically, TPS in the U.S. and ILBs in Australia.
Oh, TPS and ILBs. I'm starting to get lost in the acronym soup here.
I know, there's a lot of them. But TPS are Treasury inflation-protected securities.
Okay.
And ILBs are inflation-linked bonds, and these are designed to, protect your investment from inflation.
Right.
So the principal value of these bonds actually adjusts with inflation.
Okay.
So your investment keeps pace with the rising cost of, groceries, gas, everything.
So even when inflation's like eating away at my money, these bonds help me stay ahead.
Exactly, yeah.
Okay, what else?
So next, they recommend considering investment-grade corporate bonds.
Okay, those are the ones that are issued by companies with good credit rating.
Yes, exactly.
Like Macquarie.
Yeah, like Macquarie.
Yeah.
So investment-grade bonds are generally considered, less risky than those issued by companies with lower ratings.
Right, so it's about finding those companies that can, weather the storm.
Right, exactly.
Even when things get a little rocky.
Yeah, companies with strong fundamentals. And, diverse portfolios can still do well.
Okay, so we've got short-term bonds, we've got FRNs,
right?
We've got inflation-protected bonds, we've got investment-grade corporate bonds. What's next?
All right, so this one might surprise you a little bit, but they suggest looking at short-duration Australian sovereign bonds.
Australian bonds?
Yeah.
Okay, so why Australia?
Well, remember earlier we were talking about the Fed's dilemma? Yeah. Right. Trying to balance inflation and supporting economic growth.
Right.
So if they delay cutting interest rates because of inflation worries, these Australian bonds could offer a decent yield without exposing you to, too much risk.
All right, I'm seeing a theme here. It's like finding those pockets of opportunity when everything seems uncertain.
Yeah.
Okay, I'm a little overwhelmed, I'll be honest.
Yeah, it's a lot to take in for sure, but, you don't have to become a bond expert overnight.
That's different.
Remember, these are just general recommendations, and they might not be right for everyone.
Right. It's like clothes shopping. What looks good on one person might not look good on another.
Exactly. It's all about, your individual circumstances, risk tolerance, investment goals. Those should always be your guiding, guiding stars when you're making decisions.
Right.
And it's always a good idea to, talk to a financial advisor before making any big moves.
That's good advice.
Yeah, they can help you kind of navigate the complexities of the market.
Yeah.
And find the strategies that are right for you.
Okay, so we've covered a lot of ground on bonds.
We have.
But are there, other things we should be looking at?
Yeah, I mean, there are, for sure.
I've heard a lot about mutual funds.
Right.
And ETFs, exchange-traded funds. Are those things that, we should consider in this environment?
Yeah, absolutely. I mean, those are... they offer investors a way to diversify their portfolios without having to, pick individual stocks or bonds themselves.
Okay, that sounds good. I like that. Less work for me.
Exactly, right.
Yeah. So, maybe we'll dig into those a little bit more in a future episode.
For sure.
But for now, let's
keep going.
Keep going on this journey.
Go down the rabbit hole.
Through this market mayhem. It's funny how those two companies, Macquarie and Deutsche Bank, kind of highlight the importance of diversification. And transparency.
Absolutely.
In this wild financial world.
Yeah, they're like two sides of the same coin, right?
Yeah.
Offering these really valuable lessons for investors.
Cool.
Macquarie, they've got this diverse portfolio. They managed to kind of stay afloat, even though, things were a little choppy.
Yeah.
It shows how spreading your risk across different assets can really give you that buffer against market ups and downs.
Yeah, you don't want to put all your eggs in one basket. That's what they always say.
Exactly.
And then you've got Deutsche Bank, tripping up on these complex derivatives again.
Yeah.
Really highlights the need for
transparency.
Yeah.
Huge.
When it comes to these financial products.
For sure. I mean, if you don't understand something, it's best to just, stay away. Or at least
ask somebody.
Yeah. Get some advice.
Who knows?
Yeah, talk to an expert.
Yeah, before you jump in.
Yeah, better safe than sorry, right?
Exactly. Yeah.
Especially when it comes to your money.
Totally. Okay, so big picture, as we kind of wrap up this deep dive into all this market mayhem, what are the big things we should be taking away from this?
Well, I think, the biggest thing is just to stay informed, right? Be proactive.
Yeah.
This economic landscape, it's always changing.
It's constantly changing.
It's always shifting. And the only way to really navigate it successfully is to understand, like, what's going on.
Yeah. And don't be afraid to, ask questions.
Absolutely.
Right? Like, if something doesn't make sense, do your research, talk to somebody,
exactly.
a financial advisor,
Yeah, find somebody you trust.
Yeah, find somebody you trust who can, explain it to you.
Exactly. Yeah.
So, yeah, knowledge is power, right?
Yeah.
Especially when it comes to your finances.
Absolutely. Especially these days.
Especially these days, yeah.
Yeah.
The markets can be a wild ride.
Oh, yeah.
We've seen that.
Lots of ups and downs.
Twists and turns.
Yeah, a few screams along the way.
It's like a roller coaster.
It is. It is.
But with your money.
Exactly.
Okay, so, to quote the newsletter, keep your duration short.
Right.
Keep your hedges tight.
Yes.
And your sense of humor intact.
Absolutely. Very important, that last one.
Crucial.
Especially these days.
Okay, well, until next week, dear listeners, stay informed, stay engaged, and keep exploring.
Yeah, happy investing, everybody.
Yeah, see you next time. All right, welcome back, everybody. This week we are going deep